The biggest pullback of this Bitcoin cycle may not be happening in the price chart. It's happening inside the very funds that once fueled Bitcoin's historic rally. U.S. spot Bitcoin ETFs have now seen $1.6 billion in outflows in just 1 month. Holdings have dropped by more than 100,000 Bitcoin since the October all-time high. Is this the beginning of institutional capitulation, or is this simply a healthy reset before the next move? Tonight, we break down the numbers, the psychology, and what this means for Bitcoin's future in traditional finance. Let's get into it. The big picture. U.S. spot Bitcoin exchange-traded funds, often called ETFs, are experiencing their sharpest balance contraction of the current market cycle. According to on-chain analytics firm Glassnode, U.S.-listed spot Bitcoin ETFs have fallen by approximately 100,300 BTC since Bitcoin's all-time high in early October. Total ETF holdings now stand near 1.26 billion Bitcoin. That decline reflects sustained investor withdrawals. Data from SoSoValue shows that January alone recorded $1.6 billion in net outflows. This extends a streak of redemptions that began in November 2025. It is the largest balance contraction seen so far in this cycle for U.S. spot Bitcoin ETFs. Pause. That is significant, because these ETFs were once seen as the primary driver of institutional Bitcoin adoption. Now they are under pressure. What exactly is happening? Let's simplify this. When investors pull money out of a Bitcoin ETF, the fund may need to redeem shares and reduce its Bitcoin holdings. That means actual Bitcoin can be sold. More redemptions mean more potential selling pressure. And this has happened during a period when Bitcoin's price has declined sharply from its October high of $126,000 to roughly $67,000. That is nearly a 50% drawdown from peak levels. When price falls, institutional risk managers often reduce exposure, not because they no longer believe in the asset long-term, but because volatility forces them to manage portfolio risk. That is how traditional finance works, and now Bitcoin is part of that system. The institutional psychology shift. During the rally to $126,000, spot ETFs were praised as the engine behind Bitcoin's explosive move. They opened the door for pension funds, wealth managers, and hedge funds. But institutional capital behaves differently than retail capital. Institutions hedge aggressively, follow strict risk models, adjust exposure during volatility, rebalance portfolios. When Bitcoin drops rapidly, portfolio managers reduce risk. That reduction often shows up as ETF outflows. This is not necessarily panic, it is discipline. However, discipline can still create selling pressure. The role of institutional hedging. BitMEX co-founder Arthur Hayes recently commented that institutional hedging strategies may amplify downturns. Large investors often use derivatives to hedge exposure. When redemptions rise, those hedges can trigger additional selling in related markets. This creates what some analysts call reflexive pressure. In simple terms, outflows equals selling. Selling equals lower price. Lower price equals more risk management. More risk management equals more outflows. It becomes a feedback loop, and we may be seeing that dynamic play out. Investors sitting at a loss. Another key data point from Glassnode: the estimated average entry price for U.S. spot Bitcoin ETF investors is around $83,980 per Bitcoin. With Bitcoin currently trading near $67,000, the average ETF holder is sitting on roughly 20% unrealized losses. This matters psychologically. When investors are in profit, They are patient. When investors are underwater, behavior changes. Some hold, some hedge, some exit. This environment increases short-term volatility. Broader crypto outflows. This trend is not isolated to Bitcoin. Digital asset investment funds have recorded 4 consecutive weeks of withdrawals. Total outflows during that period have reached approximately $3.7 billion. That suggests a broader risk-off mood across crypto markets. Risk-off environments typically emerge when macro uncertainty rises, interest rate expectations shift, liquidity tightens, equity markets weaken. Bitcoin, despite its long-term thesis, still reacts to macro conditions. Are ETFs losing their power? Here is the critical question. If ETFs drove the rally, are they now driving the decline? The answer is more nuanced. Senior ETF analyst at Bloomberg, Eric Balchunas, noted that cumulative net inflows into U.S. spot Bitcoin ETFs still stand near $53 billion. Yes, that is down from a peak above $63 billion in October, but it remains historically strong. In fact, total inflows are still well above early industry expectations. That means institutional adoption has not reversed. It has slowed. There is a difference. Historical context. Every Bitcoin cycle has had deep corrections. In previous cycles, 30% corrections were normal. 40% drawdowns were common. Even 50% pullbacks occurred within bull markets. What makes this cycle different is ETF integration. Now, Bitcoin is connected with traditional financial flows. That adds both stability and volatility. Stability during accumulation, volatility during de-risking. Is this capitulation? True capitulation typically involves panic selling, massive volume spikes, extreme fear indicators, and forced liquidations. So far, ETF outflows appear controlled. There is no evidence of systemic stress. There is no collapse in institutional participation. There is simply caution, and caution during drawdowns is normal. Long-term structural impact. The most important takeaway: Bitcoin ETFs still hold approximately 1.26 billion BTC. That is a substantial share of circulating supply. These holdings did not disappear. They reduced modestly relative to peak levels. Even after months of outflows, total net inflows remain historically strong. That suggests structural integration into traditional finance is intact. The current pullback appears cyclical, not structural. What happens next? Short term, volatility likely continues. Outflows may persist if price remains below average ETF entry levels. Mid-term, stabilization could occur if macro conditions improve and Bitcoin finds support. Long-term, institutional infrastructure remains in place. ETFs exist, custody exists, regulation exists, access exists. Those structural changes do not reverse easily. Bitcoin's price may fluctuate. ETF balances may rise and fall. Investors may rotate in and out. But one fact remains unchanged. Bitcoin is now embedded in the traditional financial system, and that changes everything. This pullback may feel dramatic, but in the context of Bitcoin's history, it may simply be another chapter in a very long story. Stay informed, stay rational, and always look beyond the headline.